Welcome to our deep dive into specialist cost management techniques. In today's competitive business environment, understanding how to manage and reduce costs is crucial for long-term success. This video will guide you through essential concepts like cost control, cost reduction, target costing, life cycle costing, theory of constraint, throughput accounting, and environmental management accounting. By the end, you'll have a comprehensive view of how these techniques can be applied to maximize profit. Cost control is all about regulating operational costs through the actions of managers and executives. It involves setting targets or benchmarks, monitoring actual performance against these standards, and taking corrective actions when necessary. The process is continuous, requiring regular comparison and adjustments to ensure costs remain within acceptable limits. Cost control can use both internal and external targets, with techniques like standard costing and budgetary control. Cost control to be effective, several prerequisites must be in place. First, there must be clear delegation of authority and assignment of responsibility, ensuring each cost center is managed by someone accountable. Second, an agreed plan with defined objectives and goals is essential. Motivation, whether financial or non-financial, helps drive individuals toward these goals. Timely and efficient reporting allows for quick identification of issues, and recommendations must be followed. Cost reduction goes beyond temporary saving. It's about achieving real, permanent reduction in the unit cost of goods or services without sacrificing quality or utility. This is a continuous process, focusing on standardization, simplification, and efficiency improvement across manufacturing, administration, selling, and distribution. Unlike cost control, which maintains costs within set limits, cost reduction seeks to push costs down to the optimal level. It requires a dedicated scope of cost reduction is broad, covering product design, organizational structure, factory layout, equipment utilization, and production planning. For example, over 80% of production costs are committed at the design phase, making efficient product design a key area for cost saving. Organizational improvement, such as clear role definition and effective communication, also contribute. Reviewing factory layout and equipment usage can eliminate waste and maximize. Achieve cost reduction. Organizations use a variety of tools and techniques. Value analysis examines products and processes to identify unnecessary costs. Inventory management methods like just-in-time and backflush help minimize stock and associated costs. Business process reengineering rethinks workflows for greater efficiency. Target costing and Kaizen costing focus on continuous improvement and cost control from the design phase onward. Standardization of products. Standardization means using the same component across multiple products, which brings several benefits. For instance, an automobile manufacturer might use the same door handle or wiper for all car models. This approach leads to economies of scale, simplified inventory control, and makes it easier for operators to handle components. By reducing the variety of parts, companies can negotiate better prices, streamline production, and minimize errors. Ultimately, standardization. It's important to distinguish between cost control and cost reduction. Cost control focuses on keeping actual costs within set standards or budgets, often resulting in temporary saving. Cost reduction, on the other hand, aims for real, permanent saving without compromising quality. While cost control relies on compliance with standards, cost reduction challenges those standards to find new, more efficient ways of operating. Cost reduction is dynamic and universally applicable. Target costing is a proactive cost management technique that starts with the market price and desired profit margin to determine the allowable cost of a product. Unlike traditional cost plus pricing, where costs are calculated first and a profit margin is added later, target costing works backward from what customers are willing to pay. This approach ensures that products are designed and produced within cost constraints, aligning with market reality and customer expectation. Target costing. Target costing is more than just a costing method. It's a comprehensive management technique. It involves the entire value chain, from initial design and engineering to manufacturing, distribution, and after-sales service. The process is structured to ensure that cost management begins at the earliest stages of product development and continues throughout the product's life cycle. By involving cross-functional teams and focusing on market-driven prices, target costing helps organizations. Additional cost plus pricing ignores competitor pricing and customer willingness to pay, often resulting in products that are overpriced for the market. Target costing addresses these limitations by starting with the market price and working backward to determine allowable costs. This ensures that products are both competitive and profitable. By focusing on what customers value and what they are willing to pay, target costing aligns product development with market demand, reducing the risk of unsold. Let's look at practical example. Kalun Toy Company wants to launch a new toy with a target selling price of 100. After accounting for 15% royalty and 25% profit margin, the target cost is 60 per toy. However, the current cost structure totals 30, exceeding the target. This means the company must find ways to reduce costs by 10 per toy, perhaps through value engineering, process improvement, or negotiating better material prices. This target costing process involves several key steps. First, organizations must shift their mindset to prioritize market-driven prices and customer needs. Next, they identify market requirements for design and utility, establish a target price based on competition and demand, and set a target profit margin. The target cost is then calculated by subtracting the profit margin from the target price. Teams brainstorm and analyze alternatives to reduce costs using tools. Close the gap between actual and target cost. Manufacturers must ask critical questions. Can materials be eliminated or substituted with cheaper alternatives? Can labor productivity be improved? Is there potential for economies of scale? Can components be outsourced to save time and money? Reviewing the supply chain and reducing indirect costs through process reengineering are also essential. By systematically addressing these questions, organizations can identify. Target costing is built on 6 core principles: leadership of target selling price, customer focus, teamwork, reducing product life cycle cost, focusing on the design stage, and attention to all stages of the value chain. These principles ensure that cost management is integrated into every aspect of product development and delivery. By emphasizing customer needs and involving all stakeholders, organizations can create products that are both cost-effective and aligned with market. Target costing offers numerous advantages. It fosters a culture of innovation and continuous improvement, encourages proactive cost management, and enhances employee empowerment. By involving suppliers and focusing on value-added activity, organizations can achieve competitive advantages and reduce time to market. Target costing also ensures that products are designed to meet customer expectations for quality and price, leading to better alignment with market demand and improve. Despite its benefits, target costing has some drawbacks. The development process can become lengthy due to repeated design iteration. Monetary cost cutting may lead to internal conflict, and reaching consensus among cross-functional teams can be challenging. Detailed cost data is required, which can be expensive to develop. There's also a risk of reduced product quality if cost reductions rely on cheaper, inferior components. Effective implementation requires strong leadership. Avery Limited adopted target costing to produce the world's most affordable bike, Zingaro. Maintaining the target price was challenging due to rising input costs, but the company used value engineering and Kaizen costing to continually refine the design and production process. Environmental concerns, safety issues, servicing challenges, durability, and global competition were all addressed through strategic action, such as adhering to emission norms, improving safety standards. Target costing can significantly boost profitability by maintaining a constant focus on product cost throughout the life cycle. Management receives regular cost reports, enabling informed decision and precise pricing strategy. Unlike cost-plus approaches, target costing ensures that products are priced competitively from the outset, leading to better sales performance and market share. When implemented effectively, target costing becomes a central part of an organization's strategy for sustain. Target costing is most effective in industry, where a large portion of cost is committed during the design phase, such as assembly-oriented manufacturing and companies with diverse product lines. It's less useful in service industry or raw material production, where costs can be adjusted more flexibly. Organizations using factory automation, just-in-time system, and value engineering benefit most from target costing, as it helps manage costs from the earliest stages of product. Robust target costing system breaks down total target cost into components, allowing for detailed value analysis and value engineering. Value analysis reviews existing products to identify cost-saving opportunities without reducing customer value, while value engineering applies similar principles to new products. Both approaches involve cross-functional team and supplier collaboration, ensuring that cost reduction efforts are comprehensive and sustainable throughout the product. Value analysis and value engineering are systematic approaches to cost reduction. Value analysis focuses on existing products, seeking ways to eliminate unnecessary costs without sacrificing function or quality. Value engineering applies these principles during the design phase of new products, aiming to avoid costs before they occur. Both methods involve reviewing product features, materials, and processes, considering alternatives, and collaborating with suppliers to find. During a value engineering review, teams ask critical questions. Can we eliminate non-value-added functions? Is there excessive durability or reliability that can be reduced? Can the design be simplified or minimized? Are there opportunities to substitute parts or combine steps? Can the product be designed for easier manufacturing or assembly? Should we seek supplier assistance or consider entirely new approaches? By systematically addressing these questions, organizations can. Kaizen costing complements value engineering by focusing on continuous incremental improvement throughout the product's production life. While value engineering achieves significant cost reduction during the design phase, Kaizen costing ensures that small, ongoing savings are realized as the product evolves. This approach is especially important in competitive markets where prices are under constant pressure, helping organizations maintain profitability over time. Life cycle costing tracks all costs and revenues associated with a product from inception to abandonment. The goal is to maximize total profit over the product's life by understanding cost patterns and making informed strategic decisions at each stage. Life cycle costing encourages early action to generate revenue or reduce costs, promotes long-term thinking, and provides a comprehensive framework for analyzing product profitability. Product's life cycle typically includes 4 stages: introduction, growth, maturity, and decline. Each stage has distinct characteristics, such as sales volume, profit margin, customer types, and competitive dynamics. Strategies must be tailored to each phase, from aggressive promotion and market development in the introduction stage to cost control and product differentiation during maturity, and finally, managing decline through product extension or discontinuation. The introduction stage, the product is new to the market and awareness is low. Companies invest heavily in branding, packaging, and promotional activity to attract early adopters. Distribution channels are established, and pricing strategies may vary between penetration and skimming. Profits are typically low or negative due to high initial costs, but the focus is on building a foundation for future growth. During the growth stage, sales expand rapidly as customer awareness increases and competitors enter the market. The focus shifts to building brand identity, maintaining product quality, and maximizing availability through strong distribution. Pricing strategies are adjusted to balance profit and market share, and efforts are made to retain customers and encourage repeat purchases. Long-term relationships with customers and partners become increasingly important. The maturity stage, sales growth slows and competition intensifies. Companies must differentiate their product through improved features or enhanced services. Prices may be reduced to attract price-sensitive customers, and promotional incentives are used to maintain interest. Distribution becomes more intensive, and efforts are made to win over competitors' customers. Managing costs and defending market share are critical at this stage. Decline stage is marked by falling sales and profits, often due to technological advances or changing consumer preferences. Companies may choose to maintain the product for loyal customers, phase it out, or use it as a platform for launching new products. Pricing and promotional efforts are minimized, and unprofitable outlets are closed. The key is to manage the decline efficiently while exploring opportunities for product extension or replacement. Life cycle costing offers several benefits. It encourages early action to generate revenue or reduce costs, supports long-term decision-making, and provides a comprehensive view of product profitability. By tracking costs and revenues across all stages, organizations can identify opportunities for improvement, allocate resources more effectively, and make informed strategic choices that maximize returns over the product's life. Theory of Constraints (TOC) focuses on identifying and managing bottlenecks that limit an organization's throughput. Developed by Goldratt and Cox, TOC advocates maximizing the use of bottleneck resources while avoiding unnecessary buildup of inventory. The goal is to increase throughput, minimize investment, and reduce operating expenses. TOC provides a structured approach for improving performance by addressing the most critical constraints in the production process. EOC uses three key operational measures: throughput, the rate of generating money through sale; investment, money tied up in assets; and operating expenses, money spent to turn investment into throughput. The objective is to increase throughput, minimize investment, and decrease operating expenses. By focusing on these measures, organizations can optimize their operations and improve overall profitability. Goldratt's 5-step method for improving performance under TOC includes identifying system bottlenecks, exploiting the bottleneck, subordinating other activities to the bottleneck, elevating the bottleneck's capacity, and repeating the process as new constraints emerge. This cyclical approach ensures that organizations continuously address the most critical limitation in their operation, leading to sustained improvements in throughput and profitability. Throughput accounting, derived from TOC, measures the rate at which a business generates money through sale, focusing on the return per bottleneck hour. Only direct material costs are treated as variable, while labor and overheads are considered fixed. The throughput accounting ratio compares throughput per bottleneck minute to factory cost per bottleneck minute. A ratio above 1 indicates profitability, guiding organizations in product mix and resource allocation decisions. TOC and throughput accounting offer advantages such as reduced inventory, more productive machine, shorter lead time, and better customer service. However, they also have limitations, including a focus on short-term goals, potential neglect of quality, and reliance on fixed operating expenses. These methods are best suited for short-term product mix decisions and should be integrated with broader management strategy for optimal results. Environmental Management Accounting (EMA) integrates environmental considerations into management accounting. EMA identifies and estimates the costs of environment-related activity, helping organizations control these costs and make sustainable decisions. It goes beyond financial costs to include environmental impact, supporting product pricing, budgeting, investment appraisal, and performance target setting. EMA is increasingly important as regulatory requirement. Environmental costs can be classified in several ways. Internal costs are borne by the organization and impacted income statement, such as resource usage and regulatory compliance. External costs are borne by society, like pollution and health impact. Our classifications include conventional costs, hidden costs, contingent costs, and relationship or corporate image costs. Understanding these categories help organizations identify, allocate, and control environmental costs. MA uses several techniques to identify and allocate environmental costs. Input-output analysis tracks material inflows and outflows, highlighting waste. Flow cost accounting records material losses at each production stage. Life cycle costing considers environmental cost over the product's entire life. Activity-based costing allocates environmental costs based on activities and cost drivers. These methods provide a clear picture of environmental impacts and support better. Once environmental costs are identified and allocated, organizations must implement control measures. This can involve waste reduction, efficient water and energy usage, improved transport and logistics, and better management of consumables. Techniques like total quality management, TQM, and continuous monitoring help organizations achieve environmental objectives such as zero waste or zero pollution, while also reducing costs and improving stakeholder relations. MA plays a crucial role in product and process-related decision-making. By converting environmental overheads into direct costs and allocating them to responsible products or processes, EMA enables more accurate pricing, profit margin analysis, and product portfolio decisions. Organizations can redesign products or processes to reduce environmental costs, improve housekeeping, and enhance overall sustainability, leading to better long-term business outcomes. EMA offers significant benefits, including improved revenue through enhanced brand image, cost reduction from efficient resource use, and better stakeholder relations. However, it can also increase costs due to compliance and reporting requirements, place additional burdens on management, and result in significant costs if environmental management fails. Balancing these factors is essential for successful EMA implementation. Recap: we've explored specialist cost management techniques, including cost control, cost reduction, target costing, life cycle costing, theory of constraints, throughput accounting, and environmental management accounting. Each technique offers unique tools and strategies for managing costs, improving profitability, and ensuring sustainable business practices. By integrating these approaches, organizations can stay competitive, adapt to changing markets, and achieve long-term success. Applying these techniques in real-world scenarios requires a strategic mindset and cross-functional collaboration. Whether it's using target costing to launch a new product, implementing value engineering for cost saving, or adopting EMA for sustainability, organizations must tailor their approach to their specific industry and market condition. Continuous improvement, data-driven decision-making, and stakeholder engagement are key to maximizing the benefits of specialists. Thank you for joining us on this comprehensive journey through specialist cost management techniques. Remember, mastering these concepts is not just about reducing costs, it's about creating value, driving innovation, and building a sustainable future for your organization. Continue exploring, stay updated with the latest practices, and apply these insights to achieve operational excellence and long-term success.